In this video, I want to talk about paying dividends to shareholders or stockholders in a corporation. My intention for this video is to show you the accounting entries. However, this is a subject that I strongly urge you to talk to your tax preparer about to make sure you're doing things in accordance to your specific business structure. My focus in this video is going to be talking about cash dividends in a C corporation. First of all, let's just talk about some background information very briefly. Dividends are simply distributions of assets, which cash is an asset, or shares of stock from a corporation to its shareholders. And I'm using the word shareholders here, but stockholders is the same thing. The owners of the company who own the company by having shares of stock. A cash dividend is a distribution of a portion of the company's earnings, which when I say when accountants say cash, majority of the time in practice, it comes from the checking account. A stock dividend would be when you issue additional shares of stock instead of cash. And in this video, I'm going to show you the entries for cash dividends. Entries for stock dividends would be a completely different video. Before we get into the entries, I just want to briefly mention tax implications of cash dividends. And of course, this is going to depend on your specific area that you are taxed in, and of course, what your business structure is. Dividends are not going to be shown as an expense on the profit and loss, and you're not going to deduct them for purposes of income tax. Dividends are treated as a reduction in retained earnings. Retained earnings is simply the cumulative sum of prior year earnings. Shareholders who receive dividends might need to receive a 1099 DIV at year end, and that's something that I recommend talking to a tax preparer about to see whether you would do that or not. And then I also want to talk about dates. You would have 3 dates involved here. The declaration date would just be the date that the corporation officially declares the dividend, and they would estimate the amount of the dividend based on how many shares of stock were outstanding. A record date and a payment date would be established at that point, and then the record date would be the date of record. Whoever owns stock on this date would get the dividend. And then you would have the payment date, which is when the dividends would actually be paid. Now, if you're a small corporation, maybe you have a corporation where you're the only shareholder, or it's a family-owned corporation and the actual shareholders don't really change, you may have all 3 of these dates on one day. So now let's talk about your actual entries. First of all, you'll need to set up some accounts in your chart of accounts. You'll need a dividends payable account. This would be a current liability account. And then you would have a cash dividends account. This is going to be an equity account. And I put cash dividends here, but you could call it something like dividends declared, dividends paid, or just dividends. And this is going to be a temporary account that's closed to retain earnings at year end. Majority of the time you can ask your tax preparer to give you the year end entries. There might be some adjusting entries, there might be some closing entries, and you would want to work with the tax preparer on that. I'm focusing in this video on the entries for the declaration date and the payment date only. This would be what the entry might look like on the declaration date. When you declare dividends, you would debit the dividends account and you would credit the dividends payable account. Dividends is going to be an equity account. Anytime you're pulling out of equity, like an owner draw or some kind of distribution to the owners, that is a debit to take out of equity. When you debit an equity account, you are subtracting from equity. And then for the payable account, that's a liability account, and you add to debts with credits in accounting. So at this point, we're just showing that they owe $2,000 at this moment to the shareholders. Okay, and then I'm going to actually show you in accounting, we use something called T accounts. So if you were to look at these 2 accounts as a T account, this is what it might look like. The dividends payable account would have the $2,000 on the credit side, and the cash dividends account would have it on the debit side. In your software, you would show it more like a ledger as opposed to a T account, but I just wanted to throw this in here in case anybody likes to see the visual left and right side of the account. Okay, and then you would have the record date. No entry would be made at this point. It would just be a matter of seeing who owns stock on this day. And then you would have the payment date, when the dividends are actually paid. And this is going to be a debit to subtract from your payable account. When you owe money, it's a credit to a payable account. When you pay off that debt, it's a debit to offset the credit. So that would be a debit to subtract it back out of the payable, and a credit to subtract from cash or checking, which is an asset account. And for those of you, again, who like the visual to see it in a T account, I also put that here. So now we did a debit to dividends payable. The debit is going to offset the credit that was already there. And then we still have the cash dividends account here and the subtraction from checking. So I know I went through that kind of fast because my intention is not to show it to you like a textbook. This would be how I would teach it in a college class. However, I want to show you how this would actually look if I were to do this all in a software like QuickBooks or Wave. So I'm actually going to show you these entries in both. Now I'm going to look at how the entries might look in QuickBooks. I set up two accounts in the chart of accounts here. I set up a dividends payable account under other current liabilities, and I set up a dividends equity account. Now, this detail type says partner distributions, and that's just because I couldn't really find a better place for it. So you could use owner's equity, you could use shareholder distributions, owner distributions, partner distributions. That part isn't as important as the fact that it needs to be an equity account type. And then once I have the account set up, I'm going to do the first entry. So I would go to New Journal Entry. I'm going to put the journal date as the declaration date when the dividends were declared, and I'm going to debit dividends, which is the equity account. Debits to equity subtract from equity, and then I'm going to credit dividends payable to show that the company owes money, because as soon as they declare the dividends, they owe the money. And when you add to debt of a business or add to liability accounts, that would be a credit. And then you would have a memo, more than likely, or description to describe how many shares there were, maybe how much the dividends were, maybe the payment date and that sort of thing. But this would be your debit and credit entry. I'm just going to go ahead and save and close. And let's just look at the balance sheet real quick just to see what it looks like on there. Here is the dividends payable line item, and that is under other current liabilities. And dividend shows as a negative in the equity section. Now let's look at how it might look when you actually pay the dividends. Now on the PowerPoint slides, I had one journal entry, which was a debit to dividends payable and a credit to checking or cash. But in real life, if you're paying multiple people dividends, like if you're paying 10 people $200 each, then you're gonna probably in practice have individual entries or individual checks for each person that you're paying dividends to. And you could do one journal entry if you wanted to, just like I had in the slide, but then your entry in QuickBooks isn't going to match your bank transactions, your bank line items, because on your bank statement, it will show as $200 items 10 times, and it's just not going to match up. So what you could do is just write checks or do journal entries for each individual $200 payment. So I would just do new check, and I would probably set up each shareholder as a payee. I'm just going to add one here. I'm not going to add one for each individual check. But basically what I would do is just create the check, and I'm going to actually put these ahead to December 1st. And my category would be dividends payable. So this is going to have the same debit credit effect as the journal entry I had on the PowerPoint slide. So let's say this was 200, and then I would save a new and do this same thing 10 times and have 10 checks to match what actually happens on the bank side. So I'm just going to go ahead and enter these real quick. Okay, so I entered 10 checks with the category being dividends payable. I did that 10 times, and now let's view the dividends payable register. Notice my dividends equity account has not changed. That balance needs to stay there until year end when taxes are filed, and then that amount can be closed. But the dividends payable account should zero out after the checks were written to the shareholders. And you can see that I had one increase to this account when I did that original journal entry when the dividends were declared, and then on the payment date when the dividends were actually paid, it just came right out of dividends payable. And I could have done a journal entry instead of a check, or journal entries, and if I had done it that way, I would have just done new journal entry, debit dividends payable, and credit checking. So if you're a sole shareholder for your own corporation and you just paid out $2,000 in dividends to yourself, then this entry or one check would be fine. But if you're paying for multiple people, then you would do something more like what I did here with a check going to each individual shareholder. And then let's go ahead and look at the report so we can see what that looks like. And now you can see the dividends payable account was zeroed out, and then the dividends account still shows that negative 2,000 to show that $2,000 in dividends were paid out to shareholders. And then of course, after year end is over, you would close this balance. Like I said earlier, work with your tax preparer to do those closing entries. And then for the final part of the video, I want to just show you how to do those entries in Wave. For the most part, journal entries are the same no matter what software you are using. However, Wave is a little bit different because when you run a balance sheet, let me just show you. Instead of having a retained earnings account, Wave just puts it in this profit for all prior years line item. You cannot post journal entries to this account. So if you're using Wave for accounting, it's going to be a little different, and I would recommend talking to your tax preparer about the best way to go about this. But I'm going to go ahead and show you the entries to get the information in Wave, and then at year end you can deal with the closing entries and what to do with it with your tax preparer. So I went to Accounting, Chart of Accounts, and I set up the dividends payable account under other short-term liability. And then under equity, you could really put the dividends account under either one of these sections. I went ahead and put it under retained earnings since dividends are supposed to be a reduction in retained earnings. And then once you have your account set up, you can do your journal entries. So I'm just going to go to Transactions, go to More, Add Journal Transaction. And I'm just going to put a debit to dividends. And we'll just use the same numbers, same example, and a credit to dividends payable. I'm subtracting from equity with the debit to an equity account and adding to debt with a credit to a payable account. And then if I wanted to write a description, I could do that to leave some details. I'm going to go ahead and just save this and look at the report real quick. So we're going to look at a balance sheet, and you can see the dividends payable here of $2,000 showing they owe the $2,000 to shareholders, and the dividends down here under equity is a negative line item. And then on the payment date, you're going to pay the shareholder or shareholders, If you only have one shareholder, you could easily just do one journal entry. You would debit dividends payable and credit your checking account for $2,000. Just like I showed you on the PowerPoint slides earlier. Or you could instead enter it as an expense and just have the category be dividends payable. So this could work as well. Now, if you're issuing dividends to multiple people, if there's 10 people getting $200 each or something like that, then you would have 10 expenses for $200. So I'm going to do that since I did that in QuickBooks also. So I'm just going to add those real quick. Okay, so I entered 10 expenses of $200 and I put the category as dividends payable and I put the date as the payment date. Now, if you have your bank account connected, it may be better to wait till they come in through the bank, through the connected account, and categorize it as they come through. But I went ahead and entered all 10 expenses. So you could have one expense if you're the only shareholder. You could have multiple expenses if you have a lot of shareholders. Now that I posted the payments of dividends, I'm going to go back to the report and I'm just going to look at that real quick. So I'm going to go to the balance sheet as of the payment date, which is December 1st. And I can see that it no longer shows dividends payable here. And then down here, it has a negative line item for dividends. So hopefully that was helpful. If you have any questions, feel free to comment below, and thank you for watching.